Following the massive tech stock rally that came amid the first quarter results season, this quarter has been more rocky, with more than 80% of S&P 500 companies reporting earnings. It's obvious that investors aren't so easily impressed this time around. According to FactSet, companies that have beat earnings in the second quarter have seen an average price decrease of 0.5% 2 days before the earnings release through to 2 days after the release. That marks the largest average negative price reaction to positive EPS surprises since 2011. Just to give one example, Tesla down almost 20% since reported its earnings a month ago, despite beating expectations. Joining us now, Dana Doria, Envestnet Co-Chief Investment Officer, to talk more about how we are seeing these companies react and also what else you're seeing in the market. But let's talk about earnings first here and the sort of diminishing returns from beating estimates. What is it going to take to impress investors at this point?
I think there's a lot that's being macro-driven at this point. So certainly we had a remarkable first half in the markets. And, that came as a surprise, I think, across the board pretty much, right? There was an expectation coming into this year that you were going to have lackluster markets, recession probably starting mid-year, second half of the year. And it just hasn't materialized. And it's been a phenomenal first half of the year. But now, of course, as markets do, they're sort of weighing, new information coming in. Is the Fed really going to back off? Are we going to see more rate increases? And when you have an earnings season, even beating, but valuations are high, it's going to just take a little bit more, I think, to kind of ease the market's concerns that maybe perhaps we've priced in too rosy of a scenario.
What are investors looking for then? What are they trying to hear from CEOs to give them confidence that would actually warrant, even if a company does beat on both earnings and revenue expectations and give upbeat guidance, give them all of the kind of elixir that they're looking for?
I think there's an element to it of EPS growth for next year that's being looked at. What is forward guidance? We've already priced in an expectation almost that, we would be doing well this year. But I do think there's also, as I say, a macro aspect to this. I think there's, concern among investors that the individual companies will in fact be harmed perhaps by, we now have obviously rates rising in the 10-year, hawkish comments coming out of the FOMC meeting, which shouldn't be a surprise, but markets tend to, absorb these things as they do. So I think, hearing that we're beating, but that perhaps we're not forecasting, the growth that we would like in 2024 can be concerning. I think also that if you think rates are going to continue to increase, you're concerned about places in the market that are doing well, growth, right? These tech, big companies that, perhaps, and tech in general, growth in general, where interest rates make a big difference. Interest rates rising have to bring up concerns about banks again, regional banks. We've obviously, at the beginning of the year and when we were seeing problems there, that was considered by many to be the sign that, okay, something's breaking now where the problems are beginning. Kind of dissipated, right? We came in and, kind of took care of those concerns, but that is really coming back to the fore now, and you're seeing those kind of concerns seep back into the market.
Although it's interesting, we're seeing rates at their highest since around 2008 when you look at the 10-year. Tech's doing okay today. I'm just looking at the KBW Bank Index. It's up today. Yeah. So at what point, at what level would yields really start to become problematic for these challenged areas again?
I think some of it has to do with how dependent the individual companies are on, the credit markets. So you're going to see it more in first, I think, in small cap areas where there's just complete dependency, and you are seeing a little bit of that, right? And to the extent that rate hikes are more than what the market is pricing in, this expectation, what is going to happen in September, even whether we get the hike or we don't get the hike, right? There's an element of, okay, but over the long haul, what are we looking at? Is it higher rates to go? Or, what we're pricing in now, of course, is rate decreases next year. Is that going to materialize? And we know that the FOMC meetings were a bit hawkish. And we know since then we've had some data that suggests that the Fed has no reason to reverse course on hawkishness. Now, obviously, there were some who disagreed. You saw a little bit more dispersion in the comments that came out. But if you're leaning toward hawkishness, I think, the data that's come since that meeting kind of only pushes you that way, right? We saw a little bit of cracks in unemployment, and that kind of reversed. Jobless claims, came back in under. You're seeing inflation moderating a lot. That's great. GDP blowout basically reading, right? Retail sales up. So the expectation about what the Fed's going to do is probably going to largely lean hawkish. And if that's the case, to the extent that that impacts these companies, to the extent that they're in credit markets, you would expect that to experience that.
To what extent has the international part of the equation been a looming cloud over this earnings season?
I'm somebody who looks closely at valuations as the metric, right? If you look across research on markets and what really does, at the end of the day, drive expected returns over time, valuations are a big piece of it. And, international markets are valued well comparatively with U.S. markets now. And I don't necessarily think, we represent the retail clients, right? Advisory clients. I don't know that that's really well worked into how they're viewing. And I think to a certain extent, it should be, right? That benefit from diversification. You may not experience the same level of growth, you may not expect to, but at a certain price, something is going to make sense more than something else, right? That's priced to more of a perfection.
What about in the U.S.? What is more attractive on that valuation basis?
So I do say to tend to tilt value. Look, it's really hard to argue with what tech has done and now communications, right? The enormous 8 has done. AI is probably what's carried us through the first half of this year. Let's be honest. There was this AI boom that nobody sort of saw coming. I tell you, we work with hundreds of money managers, and many of them were coming in saying fixed income focus going into 2023, right? And here we have an AI boom, and suddenly there's this possibility for this great outcome. But at the end of the day, if you look at the average retail client's portfolio, whether it's actively managed or it's just market indexed, they have a ton of that type of, right, tech, the enormous 8, inherently that bet on AI. So I tend to say, look, to the extent that you want to be in markets over the long haul, you're not worried about, which you shouldn't be, right? You're not so much worried about what's happening in the short term. Tilt a little bit towards those lower valued companies, towards the sectors maybe that are throwing off cash flow, but are not necessarily exciting and bringing that AI type story to you, because over the long haul, they do tend to outperform. And also defensive. Right? So think healthcare in terms of, if I want to be in a sector, I want to be in parts of the market that, they're plotting forward, but they tend to be defensive over time. They tend to have good quality indicators. We know these types of companies do outperform over the long haul. So I'm not saying take tons of tracking error to the overall market, but to the extent that you're going to tilt in your portfolio, I recommend tilts towards quality type companies, high profitability companies, value or names.
All right, Dana, thanks for coming in. Good to see you in person. Dana Doria is Envestnet Co-Chief Investment Officer. Appreciate it.
Thank you.